All right. We just finished by making this comparison last time. And now we're going to kind of jump a little more. I'm not sure exactly how far we're going to go here. It really just depends on how long it takes me. And we'll kind of, again, try to shoot for like 15 minutes or so. Anyway, so what do we include in inventory? And so obviously there's some easy ones, which is physically what's there. Like I can see it, I can count it. But sometimes it's not so easy, especially when you have goods in transit. So, as an example, kind of going back to our Walmart example, obviously, if let's say we're buying Coca-Cola from somebody, from some distributor or bottler, there could be Coca-Cola on a truck somewhere. And depending on the arrangement, Walmart might need to include that, and they might not. Just depends. And at the same time, let's say I make a sale from Walmart, and I make a sale to, like, let's say some company here in town where I supply Coca-Cola to them or whatever. There could be a situation where, okay, I've got stuff on a Walmart truck, getting ready to deliver it to some company somewhere, and well, when it's on the Walmart truck, do I include it or do I not include it? And the reality is, it's just not always clear. And so we have goods in transit. It really makes the physical count sort of, I'd call it an incomplete view of inventory. So whenever we're doing that, we do need to figure out, okay, do we count these items or do we not count these items depending on what they are? And so whenever there's inventory in transit, the key is who controls that inventory. If the inventory is controlled by Walmart, then that needs to be included in their physical count. And if it's not controlled by Walmart, then it would be not included in its physical count. And so there's general guidance that we have, but a lot of times it's going to be very focused on what is that arrangement with that either supplier or that customer. And that's going to determine how we treat goods in transit. And so the two broad categories, one is called free on board or FOB shipping point, and that means that legal title transfers at the point of shipment. And so let's take Walmart buying Coca-Cola from some bottler or distributor. So in that case, if it's FOB shipping point, as soon as it goes on the truck at the bottler's facility, it becomes Walmart's inventory. And so what does that mean? It means that the buyer, Walmart in this case, they would need to count those items as part of their physical count. And then Coca-Cola, in this case, the seller would not include those items because, of course, it belonged to Walmart on that truck. The other way you could arrange it is called FOB destination. FOB destination means that legal title transfers once it's been delivered to the customer. So again, thinking back to our example, in that case, when it's on that truck, it still belongs to Coca-Cola, not to Walmart. And so the buyer, Walmart, they would not include that inventory in their physical count, but the seller, Coca-Cola, would include that inventory in their physical count. So again, it's kind of contract by contract, and you have to dig into it and know the details. But at some point, legal title does transfer. And so you may have something on some truck somewhere that you need to count. And so as an accountant, it's your job, obviously, to know how those things should be handled. All right, so another one, not as big of a deal. I don't want to focus on it too much, but goods on consignment. So there are situations where, typically you have a seller and you have a buyer, and the seller sells to the buyer, right? Pretty straightforward. Like Walmart gets their Coca-Cola from some bottle or some distributor, right? So a very direct transaction. There can be a situation though where basically you have a third party, and it's like the consignee is the name for it, but where basically, hey, I'm going to help facilitate the sale. So the seller says, okay, well, let me give you my items. I'm going to physically transfer my items to you. And then the buyer comes to that place. And that's where they actually buy whatever it is they're trying to buy. And so the issue is, though, we have a physical transfer, but there's no legal transfer. And so in that case, the inventory still belongs to that seller, to the consigner. And so just understand, we talk about that, just because there's a physical transfer doesn't mean it's been sold. And so again, the key here is this middle person doesn't take legal title. And so in that case, basically, until the final transfer takes place to that buyer, essentially it stays with the seller, even though physically it's been transferred to a different place. Sales returns. That was chapter 7 in intermediate 1 in this class, or accounting 3323. So I'm not going to revisit that here. You can go back and review those lectures. I actually have them up on YouTube if you want to, but we're just going to kind of skip that for now. All right, so net purchases. So again, this is me buying inventory from someone else, right? So I'm acquiring inventory. And so when we think about the cost or things that we think about, okay, what is it? What is that purchase amount, and what's the cost of our inventory? Um, Not only is it the acquisition cost, but also any cost that I incur to get that item in the right condition and like right location for sale use or for use for sales or for use in the manufacturing process. And so it's not just that acquisition cost. There are other costs that get rolled into our inventory. And one of those is freight in on purchases. So a freight in on purchases, basically, we got to get it to the right place, right? And so there are costs that are going to be included in that. Under the perpetual inventory system, remember that's we continuously update the inventory account. Under the perpetual system, it's going to get added to our inventory account. Under the periodic system, those freight in costs typically are going to be tracked separately in another sort of temporary account called freight or transportation in. It's going to be in the 500. It's going to be treated again like this temporary expense type of account, even though it doesn't go on the income statement. It's going to be closed whenever we calculate our cost of goods sold, but it's kind of like the purchase account. And you could potentially include it in your purchase account, but normally it's going to be tracked separately. Freight out charges. So freight in is I'm bringing it to my facility. Freight out is I'm expending money to get it to my customer. In that case, it's just usually going to be expensed. It doesn't get added to inventory. It's just expense. And the real big one reason, kind of practically speaking, is that a freight out charge is something you've already sold. So, I mean, you don't put it on your balance sheet because it's transferred. You don't have it anymore. So either it's going to be a separate operating expense, which is by far the most common way to do it, or you could have it as an additional part of your cost of goods sold. So some companies have cost of goods sold and they have 10 different line items that are part of cost of goods sold. Freight out could be one of those costs. But again, it's not tracked to inventory. It's just expensed as you're paying those costs. Purchase returns, again, a situation where you bought something and then you decide to return it. Yeah, again, if we had a purchase return, how do you think we would handle this? Like, let's think theoretically, and if you want to pause here and think about it, you can, but think about the way we've been treating inventory under the two systems. And so with the perpetual inventory system, if there's a return, you're just going to take it right off our inventory account. So you're going to credit inventory and you're going to debit cash, assuming you get some sort of refund. So that's pretty straightforward. And then on the periodic system, we did a return before, and in that case, what we had done, if you remember, is we just reduced the purchase account. Another way to do it is to create that separate and distinct purchase return account. It's also a temporary expense type of account, and it gets closed out as part of our cost of goods sold journal entry whenever we prepare our financial statements. And so either way, essentially, it's going to be included or as an adjustment to our final inventory account and eventually cost of goods sold when we close everything out. And so again, so hopefully that's helpful. And then I think it's a little short on that one, but I'd rather be a little short than a little long. So we're going to stop there and we'll pick up with the next one next.